Well, good afternoon. Happy Friday, February the 19th. Mark Milam here, your mortgage professional with Highland Mortgage, coming to you with this week's interest rate summary and market update. What a month February has been in the mortgage industry. Unlike anything we've seen in quite a while. There's an adage in investing that you don't try to catch a falling knife. You wait for the value of the security to bottom out and rebound. And really the rebound just hasn't come for mortgage-backed securities. We've seen them decline really for pretty consistently over the entire month, precipitously over the past week or so. And all of this comes amid concerns that inflation may be a problem sooner than later as the economy starts to heat up a little bit. We've seen a strong manufacturing number. We understand that the vaccine now, we're not out of the woods as it pertains to the pandemic, but the vaccine is certainly slowing the infection rate, which gives folks a lot of hope for Q2, Q3, Q4 of this year from an economic standpoint from the country. That's all great news for the country. It's not such great news for mortgage-backed securities because these bonds are selling off, people are placing their money elsewhere, and as the value of the security drops, the associated price goes up. So let's talk about that for a second, because it's not like rates are in terrible territory. As a matter of fact, for a lot of borrowers, especially high credit borrowers, you can still avail yourself of a mortgage rate in the twos, especially if you're purchasing. But what it is going to affect is affordability, because the difference between a rate at 2 3/8 and a rate at 2 7/8 is quite a bit when you get the loan amount up into that $500,000 range. As a matter of fact, if we look at the affordability index, well, these are the mortgage-backed securities. Let's cover those first. Red days are bad days, where the value of the security is selling off and the associated rate is moving higher. And you can see really here since late January, early February, it's been a pretty consistent trend, with the exception of these 2 days here. It's been a pretty consistent trend downward. We saw a really poor day on February the 16th, and then today here hasn't been a whole lot better. That's why folks who missed the boat on refinancing in early February are now kicking themselves, because their interest rate is 1/4 to 3/8 higher than it would have been otherwise. Just a matter of trying to time the market correctly. Now, the problem with the catching a falling knife adage is, when do you reach out and grab it? Because the odds of a bounce back here are not terribly strong. If we start looking out into the spring and in the summer, what has made interest rates so low for so long is zero concern about inflation, major concern about the health of the economy. And as we exit this pandemic, those are going to reverse. We're going to have some concerns about inflation and less concerns about the health of the overall economy in general. Now, let's take a look at the affordability index, because this is the concern. So right here, this is the Economic Research Federal Reserve Bank of St. Louis, and they post this housing affordability index, which basically talks about, what the typical family can afford for monthly mortgage payments on a typical home. And the lower the better. The lower means the more affordable. And you can see towards the end of the year in 2020, we started to see this number tick up. Now, these numbers always lag a little bit. We don't have real-time data, but you can expect that number's headed back up here to where we were in maybe mid-spring of 2020, an affordability index a little higher, up around 182. That just means some people who were able to afford whatever property they were looking at when rates were at 2 3/8 or 2 1/4 are not going to be so comfortable affording that house with rates at 2 3/4, 2 7/8, or even 3%. That's something to keep an eye on, especially as we've seen inventory tighten in the metro Atlanta area and housing prices go up accordingly. So we're sort of in this vice between what the interest rates are and where housing prices have gone, and we're getting into this corner to where affordability is going to be caught in the crosshairs. It probably will mitigate the rate of appreciation that we're seeing in 2021 versus 2020. One other article, if you didn't catch it, on Market Watch, talks about mortgage rates soaring to the highest level in months amid inflation concerns. That's just echoing what we're talking about, that the lowest rates of all time are probably in the rear view mirror. And barring some unprecedented national or global event, that's probably accurate, that we need to go ahead and say goodbye to the lowest interest rates. It was fun while we had them, but we still have really aggressive pricing. We just need to be smarter about picking our moment. If you're not talking to a lender who understands these market dynamics, please feel free to give me a call or shoot me an email, mark.milam@highlandmtg.com. Have a good weekend, everybody.